Good day, students. What we're going to be doing in this session and this recording is to look at the MCQ test that was written on the 17th of May. I've pulled some statistics for the overall quiz summary. The average score was 61%, with the highest score being 18 out of 20. 2 people actually managed to score this high score. The lowest score was scored by one individual who got 15%, unfortunately. And the average time taken to take the test was 56 minutes, as you were given a full hour to complete the test. Let's go through each of the questions. Question 1, 94% of the candidates managed to answer this correctly, where you had to decide what is a current asset, okay, out of those 4 options. The current assets, remember, is an asset that will convert either into cash in the next 12 months, or the company expects that it is in the normal operating cycle. If we look at all the other options, they did not meet this requirement, so you had to select that it's an item currently owned by the firm, but that will convert into cash within the next few months. Examples of these are accounts receivables, or you've got any other receivables that you may have that will convert into cash. You've got actual cash and cash equivalents that also meets the definition of an inventory. Okay, second question. As seen on the income statement, your depreciation reduces both the taxable profits and the net profit after tax. Okay, so for the SARS, SARS allow us to also deduct a wear and tear allowance. And so when you apply the tax rate, you are going to apply it, remember, as I said, on the profit before tax figure, which has already sort of taken into account your depreciation. So the depreciation is a deduction against both your taxable profits and the net after profit after tax. Unfortunately, only 63% of the candidates got this right. Some answered that 25% answered that depreciation is shown as an expense but does not affect the taxes payable. It does affect the taxes payable, given that we get a wear and tear allowance from SARS, and they do allow us to reduce our taxable profits with the wear and tear allowance. Okay, question 3. A firm has 300 in inventory, 600 in non-current assets, 200 in accounts receivable, 100 in accounts payable, and 50 in cash. What is the value of the current assets? So I've completed this question here. On the left, you'll notice I've added up the inventory of 300, the 600 non-current assets. Of course, that by definition, they are non-current assets. They've already been provided that they're non-current. 200 was accounts receivable, 50 in cash, 100 is in accounts payable, so that only meets the current liabilities definition. So if we were to add up all 3, we get to an answer of 550. 550 is the correct answer, and 88% of these candidates got it correct. Okay, if you go to the next question, the next question says, Tim's Playhouse paid 155 Rand in dividends and 220 in interest expense. The addition to retained profits, which is retained earnings, is 325, and the net new equity is 50. The tax rate is 25%. Sales are 1.6 and depreciation is 160. What are the profits before interest and tax? Or the EBIT, which is earnings before interest and tax. If you look at my calculation here on the left, they gave us sales and depreciation. Okay, if I calculate sales less depreciation, I get to a figure of 1,440, but it still doesn't enable me to know what the other expenses were, or what cost of sales and other expenses were. So I can't actually use this figure, but they did provide me with the percentage that actually went to retained earnings. So if 325 went to retained earnings and we declared a dividend of 155, if I add those two together, 480 profits had been moved from your income statement into your retained earnings calculation. So my profit after tax is then 480, because that's what's come through here when you add back the dividends. And then we need to work back what the tax is. They had said in the question that the tax rate is 25%. So how I work this back, I then go and calc and divide. So I take this percentage, I divide it by the 25, I times it by the 25%, and then 1 minus 25%, which is the 75%. So if you look at my calculation in detail, it's the profit after tax figure. You multiply by your tax rate divided by 1 minus your tax rate. Okay, so it's the profit after tax times your 25% divided by the 75%. You will get to the figure that was actually paid in tax. And how you can work that back is then you add your profit before tax, which is the 160 plus the 140. Just to quickly do a check on my calculation, I calculate 640 times 0.25. Apologies, 0.25. And you do get to the 160, which means I have calculated the tax correctly. So if 640 is my profit before tax, for me to get to my earnings before interest and tax, I then need to add my interest expense. So if I add back then the 220, just to get to the answer before, I should get to 860. Unfortunately, only 42% of the candidates got this correctly. Some people answered incorrectly. The people that got 640, 17% of the candidates, you guys were actually calculating the profit before tax and not the earnings before interest and tax. So what you didn't do is add back the interest expense that needed to be added back to get to the profits before interest and tax. Okay, moving along. The next question is the operating profit of ABC has increased over that of the last year, but their profit after tax has come down. So your operating profit's gone up, but your profit after tax has gone down. What are the different items that are happening before operating profit and profit after tax? So if we realize from earnings before interest and tax to profit after tax, the only thing that could actually be dependent there, because the tax rate would be the same, would only be the interest expense. Okay, so if the interest expense is the only difference between the two and your profit after tax has come down, it must mean as a company you have taken on more liabilities. If you've taken on more liabilities, you're paying more interest, which means you have geared up, which has reduced then your profit after tax. Because we know that the tax has remained the same, you could assume that the liabilities has increased or the interest expense has also increased. So the students that have put down, they have geared up, 23 respondents, which is 48% of the candidates. They would have been correct because your liabilities have gone up, which means you've geared up. Okay, the next question, the straight line method of depreciation. Okay, what does the straight line method of depreciation do? It writes off the cost of the asset. Remember, when you're dealing with total useful life, you're dealing with the cost of the asset, and it writes off this asset over an equal amount of time over its economic life. Okay, 69% of the candidates got this correct. Unfortunately, some candidates said it writes off a constant percentage of the reducing value of the asset each year. Remember, we do not use the reducing value. That is only used in the accelerated depreciation, where you are actually working each time with the net book value to calculate that percentage. But when you're looking at straight line depreciation, you're writing it off. You are splitting up the economic life, looking at the cost and splitting it equally over the economic life. Okay, so the candidates that got that 31%, just be aware you're not using the reducing value. If you wanted to use a constant percentage, it would still be on the cost, the actual amount you've purchased the asset for. Okay, the next question. The next question, Mr. Buzz shows the following in his statement of financial position. You've got non-current assets of 36,609. You've got current assets of 38,444, current liabilities of 26,300, and equity of 39,477. The missing total figure for non-current liabilities is, okay, if you look at my calculation here once again on the left, what I have then tried to do for this question 7 is then add in each and every single line item that was given. What this question is testing is that your total assets must be equal to your total liabilities and your equity. So my current and non-current assets have enabled me to calculate what the total assets figure is. but I do not have the total liabilities and equity. But if I assume my assets are equal to my total equities and liabilities, then I can already assume that my non-current liabilities is just the balancing figure of the two. I minus the equity and I minus the current liabilities. You should get to a figure non-current liabilities of 9276. Remember, this tests your accounting equation. Your total equity and your liabs is equal to your total assets. Okay, that answers question 7. Okay, going back to the question, we've got Liz Lamps. Liz Lamps, they had revenue for 2020 of 269,685 with a cost of sales of 201,185, and they had total expenses of 50,431. Revenue in 2020 was 15% higher than in 2019. They said to you that the gross profit margin and the net profit margin were the same. So your gross profit as a percentage of sales for each of the 2 years will be the same. Your net profit after tax as a percentage of the sales will also be the same. This will enable you then to calculate what the total expenses were in 2019. So if you look at what I've done here, in 2020 we're given the full information. We were given the revenue, the cost of sales, the gross profit, the total expenses, and the net profit. All I've done here is calculate a gross profit figure, which is my revenue less cost of sales. I get to a gross profit percentage of 25.4. It's just taking my gross profit divided by my revenue. I get to a gross profit margin of 25.4%. What I've done here for the profit figure is do the same thing. Take my profit after tax. As a percentage of sales, I get to a net profit margin figure of 6.7. Now, what I need to do here for 2019 is calculate the total expenses, which is this missing figure here. What I have been provided is that the gross profit margin is the same. So all I do is use that same 25.4% times the actual revenue that was 15% higher. How did I calculate this 15% higher revenue? All you do for this calculation is divide it by 1.15. So I want to reduce it by the 1.15 and say, what is the 15% lower sales in 2019? I get to that figure. I get the gross profit of 59,564 using that same gross profit margin. My same net profit margin is also 6.7%. Okay, so I use that. This total expenses will then be my balancing figure between the two. And if I calculate the balancing figure between the two, I should get to 43853. Okay, 48% of the candidates got this correctly. Some erroneously made some few mistakes. I'm not sure where you made mistakes, but the correct answer is 43853. Okay. Moving on to the next question. The net book value of the fixed assets stood at 42,620. Okay, you disposed of 2,100 but purchased 15,530 and you had depreciation of 7,490. All you're doing here is working with the 2018 opening book value. You minus the disposals, you add the purchases and subtract the depreciation. Remember, the disposals and the depreciation subtract your carrying value for that year. Okay, what balance do I sit with at 2019? I sit with a balance of 48560. If I calculate the difference between the 48560 and the 42620, I get to a difference and a movement of 5940. So your movement for that year should have been 5940. That's question 9. 17 respondents only got this correct, which was 35%. Unfortunately, the students that got it incorrect, 42% of the students, you guys were calculating the closing value. But remember, they said, how much would it have changed from? They want the movement. They do not want the total balance. So unfortunately, more students got this incorrect, but you need to read the question. They wanted the movement. Okay, I will continue with this MCQ exam in the second part as these classes are split between 15 minutes. So we will continue in the next session from question 10 onwards. Thank you very much, students.